choose the one that's going to give you the best return. And that's when you know you're in an A++ stock.
Yeah, no, I'm in agreement with that. We'll do one more last question to Sugar Market. I got Sugar Market.
Thank you, Michael. Thank you, Patrick. Once you've determined some of the interesting correlations you mentioned, how do you then determine causation? And if you can't determine causation, do you still commit to the trade? Thank you.
Oh, man, yes. Look, causation, who cares? This is the trap question, causation, because look, I'll tell you something. I did some trades even in the same 2008. I read the Stan Weinstein book like a year before, and I saw the SPX was breaking down versus it was breaking down on its below 30-week moving average. It was in a stage 4 decline, and I just went nuts and shorted like crazy. But I wasn't aware back then of the SPX versus PPI. I didn't know that I was in a macro environment where SPX had broken down versus PPI, and that the 2008 crash had a higher chance of happening and being prolonged than not. And I thought the stocks were going down because for whatever reason, right? It was a crash of Lehman Brothers, or there were bad management, and then years later, I realized that it wasn't because of all that. It was because capital flows or whatever were evaporating from those sectors, and there was a cleansing. So it's crazy because now I know that what I thought I knew moved the price, or just like, let's say a stock goes up. Let's say you have a fundamental reason. You say, oh, the stock's going up, good management. They found a drill hole. They found ounces. But then years later, you realize, it wasn't even that. It was something else. Let's say you hear a story, you talk to the president tells you, oh, no, it wasn't even moving because of that. It's because we had this other project you didn't even know about. So the cause, it doesn't really matter because it's the result. It's the aggregate of all these causes, these possible causes of all that stuff, and people placing their bets on what they think is the cause or what's going to be discounted in the future. It's the actual result, the price chart, that matters. All the rest, it's it's coffee table discussions. You could have fun with it, but trust me, years later you'll say, "Oh Jesus, that was totally not why it moved." Even today, I'm pretty sure in 4 years I'm going to look and say, "Oh, Patrick, there was something else we were missing there. There was there's a chart, there's a ratio, there's something I was missing," and that's why you cannot. It's all about probabilities, and the cause, it's secondary. It's really have fun with it, but it's not necessary at all to make money in the stock market, knowing the cause.
Yeah, no, and I will say that's where a lot of people get sucked into a lot of the stuff that you see on FinTwit, especially, by the way, if you're rules based, right? And like I am, I mean, the cause for any signal not working or the opportunity set not working for a moment in time, okay, interesting to talk about. But if you're going to follow a trading strategy that's regimented and you have a process, the last thing you want to do is try to editorialize based on a narrative that may have nothing to do with the why.
Yeah. It's fun. Some people like it psychologically going through that process, but it's useless. At the end of the day, it's useless if you want to make money. It just is.
I was actually getting at the correlations when you're determining all these different correlations that may or may not exist in the market. Now, there might be random correlations there by chance. So how, before you determine, yes, this is a correlation I'm actually going to trade on now and in future, how do you determine causation, that there is a real correlation there? It's not just a chance thing.
Oh, I could hear myself double. Can you hear me double?
You're good. Yeah, I muted, and then we got to wrap up. Yeah.
It's more the number of times it repeats the pattern that creates my confidence level that will continue repeating. So in chart trading, like I said, the trend line needs at least 3 bounces, and then on the 4th, it's valid, it breaks down. Then I know based on all the chart patterns that ever existed that these rising trend lines at that angle, when they have a break below the 3-year moving average, most of the time, an 80% chance that the implied measured move was reached. That's why chart trading works. So let's say I have this pattern where over 100 years, I've had 3 previous, now it's the 4th one, and each time that exact signal happened, no matter what the cause was of that, let's say SPX breaking down versus PPI, it produced X results, and then I could overlay the gold-silver chart. I see the performance of all those asset classes, that they all perform the same way. Each time I had those racial charts break down in the same way. Then the probabilities for me, they go up. So that's what I want to play. I want to play 80% chance in my favor and a 20% chance not in my favor. I'm good to go, you know. I'm not looking for 100%. So the cause, it's not actually the actual cause, but it's more, or the correlation of what, it's more how many times did it repeat. The more times it repeated and the more times the instruments I want to trade behaved in the same manner when that environment occurred, my head is just ringing bell lights saying this is a high probability play, and I should take a stab at it.
Yeah, I think that's a good way to frame it. Everybody, again, please make sure you follow Patrick. I'll be doing several other spaces this week as usual. Patrick, appreciate you spending the hour here with us. Again, this will be an edited podcast under Lead Lag Live on all your favorite platforms. Everybody, again, happy few year to everybody here. Thank you, Patrick. Appreciate it.
Thanks, Michael. Thanks, guys.
Cheers, everybody.
Ciao, man.